For the moment, I'm just going to take a very quick detour, talk about HDFC Life, which came out with numbers yesterday, and things are again normalizing for HDFC Life. The managing director is here, Vibha Padalkar, joins us to walk us through what transpired for HDFC Life for the quarter gone by. Good morning, Vibha. Thank you for joining us. Now, the VNB witnessed a growth of 22%, while the VNB margins improved to 25.6% in Q2, indicating an increased awareness and recovery in the life insurance industry. Is this growth sustainable?
So if I were to look at quarter two was significantly better than quarter one, and the kind of growth that we saw of 21% as against over 30% degrowth, ending overall flat at about 2% growth, just shows that quarter on quarter and month on month we have trended better. We've also consistently done better than the private industry. So if you were to look at on a H1 basis, there was a degrowth of about 11% in the private sector as against our 2% growth. And hence you saw the kind of market share expansion of 235 basis points. That gives us a lot of comfort as to H2 ahead. And while I don't want to put out a number, I would imagine that the private sector will probably end somewhere close to being flat on a full year basis, while we should show much better growth against that. And this is, of course, all things being equal on the COVID front, because God forbid if we also were to follow what Europe is going through on a rebound situation and post some caution being thrown to winds in the festive season, then some of the growth will be calibrated. But otherwise, I'm cautiously optimistic.
In the last interaction with us, Vibha, you had mentioned to us that the cash conservation is something which is going to be the need of the hour for average savers right now and average spenders. But has the persistency trend improved now? What are the trends you're getting? Because persistency in a sense is the most important factor which will tell us which way the growth of a sector or a company is moving.
It's definitely improving. Again, quarter two was significantly better than quarter one. And continuing, September was better than August and so on. So yes, we are beginning to see lesser of a cash conservation approach that we saw quite at an extreme in the month of April and May. Also, some of our old customers who would have some of our traditional policies, we have been reaching out to them to explain that they can take a loan against these policies almost over the counter, and that could be even cheaper than say taking a personal loan rather than surrendering their policies. And that is beginning to gain wider acceptance.
Okay, given the protection business is margin accretive and under-penetrated, will it continue to drive growth as well as product mix? Individual protection continued to see strong growth, but do you see that sustaining?
I think growing with this kind of a clip, and also if you were to look at as a percentage of our individual business, we have gone up to 9%, so close to 10% of our business versus about 6% of our business in H1 of last year. So we continue to see brick by brick this going up. Reason I say brick by brick is that we have to be very cautious also on underwriting. We have to be also watchful for any anti-selection that might be there. And so we like the fact that if this rather than growing meteorically, if protection share were to grow by 1 or 2% as a contribution to total year on year, we would be in a reasonably happy place.
Okay, the annuity business as well, that's seen steady growth as in H1. People outliving a policy might be the next big trend. What's the opportunity as you see it over the next 2 to 3 years?
Fairly significant, and actually I would like to talk a little bit more holistically about the retirement segment, and this has also been covered in our investor presentation, wherein we are fairly aspirational to grow at least 3x of the kind of assets under management that we today to end at about 1 lakh crore just in terms of retirement space, and that subsumes annuities, and annuities are something that are very much required just given the demographic signature that we're beginning to see of people living longer, people having access to better healthcare, and hence people outliving their savings, if you like, because of inflation still rearing its head. as a result of which the opportunity we see there, as well as product innovation on the, especially our flagship deferred annuity, wherein a person who is 50 today has another 10 years to retire and says, how do I lock in at current interest rates, but I'm going to retire in 10 years and so on. So solving for those kind of questions and to bring a lot of variance so that a person might select whatever suits him or her. It could be a joint life annuity, it could be a return of purchase price and so on. It could be an increasing annuity to in line with say inflation. So we are very, very gung-ho on this space. At the same time, again, a word of caution is that one has to be disciplined when you look at pricing of annuities. One can get easily carried away to give slightly more than what one is earning. And that, again, can be a very risky proposition. So if it's done sensibly, one can grow this segment fairly healthily. And that's exactly what you see with the 38% growth in annuities.
Sure. Vibha, the level of disbursements by banks and NBFCs, that has definitely seen some improvement. How is it that you view the contribution of bank partnerships in the overall distribution mix? And how is it that you're ensuring a ramp up on your digital infrastructure?
On the bank up, this is largely, you mentioned in the context of Credit Protect. And we are beginning to see disbursements coming back on. Some of our senior partnerships, both in terms of our own parent, HDFC, and HDFC Bank, and some of the marquee companies that are our partners, are close to normalcy of pre-COVID levels of their disbursements. Yes, there are some others, especially in the MFI space, that might take a little bit longer, or certain NBFCs that might take a little bit longer. But if you were to look at Q1 degrowth of Credit Life was 74%, and Q2 was 36%, thereby ending at about 50% on a H1 basis. And that's progressively going down in terms of degrowth. And I'm reasonably certain that by the time we end the year, we've gone back to pre-COVID levels as the disbursements start picking up. So again, all of that should mean traction in terms of margins as well as growth for us. To your second question about digital, both in terms of new business and in servicing, we are very fortunate and blessed that we have been on this journey for quite some time. We have all the tools to be able to both do new business sales through our WISE platform as well as through our VServe on serving customers. And so there is really no gap in our offerings because of COVID and because of non-face-to-face interaction.
Sure. Your total AP degrew by about 4% on an annual basis. Although the situation, Vibha, has improved and there is a recovery in the business, when do you expect the APE to normalize to earlier levels?
The degrowth is there in APE, which is a particular way of calculating with single premium. But if you were to look at on the basis of WRP, it's already a positive territory in terms of having a 2% growth. So APE is just giving a 10% weightage to single premium. So it's really around the corner.
Sure. Vibha, markets have seen quite a sharp recovery kicking in. How's the demand for ULIPs panning out? And, because you've always maintained a balanced product mix, share with us what is the product strategy for the financial year going forward?
So if you were to look at in Q2, ULIPs have gone down from Q2 of last year from 26% to 21%. And on a H1 basis from about 26% to 23%. And we've also said that we are reasonably okay with ULIPs being in that kind of a zone up to say 25%. So we're not very far off from our stated objective of product mix. To your point, yes, absolutely, that balanced product mix is very, very important to us. And that's why what you see is exactly that. So about a third of our business is par, about 30% of our business is non-par savings. ULIPs we just talked about of about between 22 to 21%. And the remaining is split between protection and annuity. So we quite are like this kind of a split, and we'll continue to operate within this broad framework.
So given the benign environment we are in, or benign interest rate environment we are in, could that force you to change some of your basic strategies of assumptions of PV and FV?
Yes, very much. So, if I were to deconstruct our investment book into three parts, unit linked is entirely to the account of the policyholder, the choice of the policyholder, and the debt equity split is again very much decided by the policyholder. Having said that, in terms of our debt portfolio, 97% are either in government securities or AAA rated bonds. So again, fairly cautious in terms of our approach. If you were to look at the other spectrum, which is non-par savings, there we have no exposure to equities and it's all debt securities and also completely hedged portfolio. Somewhere in middle is par, where about 20-25% is equity and remaining is debt. And similarly with shareholders. So these are the broad buckets. You will see that there is a long-term approach, that is one, and second is there's a bottoms-up approach to investing, looking at fundamentals of the sector rather than just doing stock picks, and that has stood us in fairly good stead in remaining amongst the top quartile in terms of performance.
All right, Vibha, thanks so much for joining us.